Okay, let's get going. This is our second chapter and our second lecture in this course. We are in Managerial accounting, and we are using the textbook Garrison, Noreen, Brewer, which is the latest edition of the McGraw series on accounting textbooks for continuing education and universities. I found it to be very good, and one of the nice things about the course is that the textbook is that the authors provide excellent PowerPoints, and that we've used these in the past, so let's continue down that path. This lecture is a fast-paced one for native English speakers. There is another lecture that is offered at a slower-paced one for English as second language students who wish to study both the English language and the content, but in this lecture it's for native English speakers. So make sure you are following the correct recorded lecture. So we'll start with Chapter 2. This is referred to as cost concepts. Now let me just get this in a lecture mode. Okay, let's get going. The first slide here, what is the work of management? It's frequently referred to in three major tasks. There's planning, there's directing and motivating, and then there's controlling. And managers throughout all organizations, profit companies, governments, state, local, federal, universities, and hospitals all accomplish these activities: planning, directing and motivating, and controlling. In the planning stage, what is this all about? Well, as you can see, we have to identify the alternatives that exist, select an alternative that does the best job for advancing the organization's goals and objectives, and then we develop budgets to guide the process forward, and we hopefully will select an alternative that will accomplish our objectives. Directing and motivating, which is the second work of management, involves the day-to-day work that happens in an organization, and we've got to keep the organization running smoothly. The analogy frequently used is keeping the train rolling along the tracks, and that involves employee work assignments. Problem solving happens on a routine basis nearly every day. Conflict resolution occurs because that can happen within the company or outside with the company, so stakeholders could have problems with our organization, suppliers, customers. Invariably there's going to be conflict, and that has to be resolved. And then the key to success in most organizations will be effective communication. Without effective communication, it's rare that an organization can succeed. We can look to none other than online ordering. When you are trying to do your taxes online with the government, you have questions, you want answers. If you go through a web process or a pre-programmed telephone process that says click 1 if you're Spanish speaking, click 2 if you're English speaking, and tries to work you through a path without talking to a human, it can be very frustrating, and perhaps your questions won't be answered. So key is effective communications. Controlling is the third step, the third major subject of work of management. And that essentially is to make sure that budgets and plans, either tactical or strategic, are being followed, and that we don't go off the rails and go down into the valley and crash and burn. Key to controlling is getting constant feedback, and that can be at a detail level, it can be at a summary level, it can be in the form of written reports, electronic reports, and these are called performance reports. And from the accounting perspective, it tends to show budget versus actual. And accountants create a budget by account, by project, by product, by customer, by geographic region, and then as the month closes, actual reports or actual information is loaded into the accounting information system. Then we can determine whether budget versus actual is being achieved, and that is a way of calling the controlling process. So what does this planning and controlling cycle look like graphically? Here I see 4 boxes, and the work of management, known as the planning and control cycle, is shown here. It's a continuous loop in nearly all organizations. Once a plan is made, they're implemented. And the controlling process starts by measuring the actual performance and then comparing those results with plan performance. Corrective activities are going to happen all the time, and that's going to be if actuals differ significantly from the plan. No one can create a perfect budget. No one can forecast accurately into the future. I should modify that. Accurate forecasts can be made, but not perfect forecasts, unless the organization or business is truly a simple one. But there will invariably be variances, and therefore explanations needed, and maybe a correction along the way is going to be justified. So decision making is involved in all of these managerial activities. So as with all lectures and all chapters, we have learning objectives. And learning objective number 1 is going to be to identify the major differences and similarities between financial accounting and managerial accounting. Okay, so here we go. We've got a nice chart showing 7 major subjects, and it compares financial accounting versus managerial accounting. So who are the users? The users are different. The users of financial accounting tend to be outside the organization. They're external. Right? They make financial decisions, or they make some decisions based on our financial reports. So the financial reports tend to be published from the accounting department under the management of the chief financial officer. And those financial reports consist of balance sheet, income statement, statement of cash flows, statement of retained earnings. Now, outside the United States, the income statement is frequently referred to as profit and loss statement. So it is historical perspective, the past. Now, measures of managerial accounting reports are those who are responsible for taking the corporation forward and who want to look forward-looking as opposed to looking in the past. A common analogy frequently used is financial reports show you history. Managerial accounting reports attempt to show you the way forward. If you were driving a car and you look to the rear view mirror, how successful can you be driving your car only looking at the rear view mirror? You're invariably going to have some problems. You want something forward-looking. So, financial accounting reports, historical-looking, it's a rear view mirror. Forward-looking reports are managerial accounting reports. So the users tend to be different. Managerial accounting reports are internal to an organization. They are not released, they are not published outside. What's the time focus? Well, historical focus will be the case for financial accounting reports. And, as we just said, managerial accounting reports will have a future emphasis. Okay? Future forward-looking versus historical-looking. Now, verifiability versus relevance. when it comes to the financial reports, the balance sheet, P&L, cash flow that's published from the accounting information system, more specifically, it's published from the general ledger. More specifically, it's published from the trial balance within the general ledger. So these financial accounting reports are going to be as precise as possible. And nothing is exact in financial reporting. That's why external auditors ask us to express ourselves as a reasonable financial position. Are the financial reports reasonably stating the situation of the organization? Reasonableness, fairness. No one can actually look to say precise, absolutely accurate financial statements. That's not reality unless it's a tiny, tiny organization with very few transactions. But we try to be as precise and accurate as possible with financial accounting reports. Key errors tend to be omissions. We simply forget a transaction, or an error. We use the wrong account to enter the transaction. So maybe we used a travel account versus a training account. That's an error. Then maybe we tried to correct that error and made another error. So instead of using the training account, when we had a travel expense, we ended up using a project account. So correcting errors tend to happen, omissions happen, and first-time errors happen. But we try to be as precise as possible for financial accounting reports. In contrast, when it comes to managerial accounting, the true emphasis is on we need this analysis now. It needs to be timely. You can't spend an inordinate amount of effort, time, elapsed time in getting managerial accounting reports out. We need it now because a decision needs to be taken by the management team or whoever to go forward. So timeliness versus precision. Number 5, the subject. The subject of the financial accounting reports tends to be the entire organization. So when you see a balance sheet, you see P&L statements, you see cash flows. Usually, for financial accounting, it's going to be for the entire organization. However, large organizations with good accounting systems have the ability to do P&Ls by customer, P&Ls by geographic region, P&Ls by product. But those usually are used inside the company. Rarely do you see that kind of analysis published for outside users. So what's published for financial accounting reports tends to be the entire organization. So it's the entire organization of IBM, the entire organization of Apple. It's not looking at Apple's Japan operations. It's not looking at Apple's sales to the Hong Kong government. It's not looking to Apple's sales of its latest Macintosh product. It tends to be the entire organization of Apple. When it comes to managerial accounting reports, we then try to get into segments because we want to make decisions, and we want to make decisions as reasonably confident as we can. So we might say, what's the P&L for the product in a specific region? So what's the P&L for a new server being launched by Dell in the North American region? That's an analysis that's very specific and can be used inside the organization. Or is our California geographic region profitable, or is it losing money? Is the China subsidiary profitable, or is it losing money? Those tend to be segments of an organization. 6th row GAAP, generally accepted accounting principles. When it comes to the financial accounting reports, which we publish outside the organization, it must follow GAAP. Absolutely. And we cannot have any other basis or framework to do so. Now, one can get into IFRS, International Financial Reporting Standards, and we'll talk about that later. That is the other framework that's used internationally. So for purposes of this conversation and lecture, we should say GAAP and IFRS. When it comes to classic financial accounting reports, we must follow those frameworks. But for managerial accounting reports, we don't have to follow GAAP. We don't have to follow IFRS. Why? Because we're not publishing managerial accounting reports. It's used entirely in-house. Therefore, it's not subjected to the accounting frameworks. Lastly, number 7, the requirements. When it comes to publishing external reports, we find ourselves going down a path of a mandatory compliance situation. So our reports have to be created and they have to be published for external users, for external stakeholders, such as banks, creditors, government, shareholders, suppliers, customers, investors. So that tends to be a very strictly defined set of deadlines, and the number of pages and the formats and the reports are very specific. When it comes to managerial accounting, we don't have mandatory reports. It's all in-house. Now, we could say that we want a daily cash report, we want a daily sales report, we want a daily accounts receivable collection effort report. So we could have daily activities or weekly activities, but it's entirely up to us, the managers and the employees, to decide what we want. We're not following a mandatory government-imposed or an accounting framework-imposed set of requirements. Okay. Moving on, learning objective number 2. Let's identify and give examples of each of the 3 basic manufacturing cost categories. Now, this is where it starts to get complicated in the world of accounting. We have manufacturers or we have merchandisers. Manufacturers are those types of organizations that actually make a product. They can either assemble it, which means they collect all the components, and in a building or a factory or a plant, they put all the parts together, all the components together, and then they come up with a finished good. That's assembly. Manufacturing is actually taking raw materials, buying the raw materials, receiving the raw materials, converting them, and that process is called work in process. And then when the conversion or the work is finished, it then becomes a finished good. A finished good can then go into inventory and can then be sold by the sales force to the customers. So we need to capture the costs all along the way, whether we are assembling products or we are actually creating the products. Now, interestingly, over the years, we've seen the entire world change from the manufacturing paradigm to a assembly paradigm. And fewer organizations actually can truly call themselves manufacturers. Nearly all firms are now assemblers. And part of this process is the result of the mastery by the Japanese organizations following Six Sigma. The Toyota, the Honda, the Nissans have removed all of the inefficiencies in making products, and they've done so by having superb relationships with suppliers of components. So Toyota itself may not manufacture, or it may not create any actual product. It may be assembling 1,000 different products or 1,000 different items into a finished good. Okay? So that's assembly. You see, that would require a great relationship with 50 or 100 suppliers, and all the knowledge, all the expertise in making a component falls upon the supplier, and therefore it doesn't require that level of expertise to be in-house at a company such as Toyota or Honda. So the people who make radios are radio specialists. The people who make tires are tire specialists. The people who make filters are filter specialists. The people who make rubber piping, rubber hoses are rubber hosing specialists. And then Toyota just has an assembly line that has 500 components being delivered at the right time to make it into a finished good. So now we must challenge ourselves as accountants and capture all of the cost categories involved in the manufacturing process. And this is not easy. So once again, we're using a car or an automobile as an example. Here we have a beautiful Ferrari. It has three major buckets of costs. Buckets, B-U-C-K-E-T-S. It's just like a paint bucket or a bucket of water. We refer to costs as buckets. So there are three major components of costs: direct materials, direct labor, and manufacturing overhead. The first two are pretty easy. Direct materials, direct labor, easily identifiable, easy to understand. The murky one tends to be the manufacturing overhead. Here's where all the complication happens. So let's see. It's easy to understand. Raw materials are an integral part of the product, and they can be traced specifically to the product or the supplier, and we can capture the costs and maintain the costs pretty easily. That's direct materials. Direct labor, that can be traced to units. It can be either a human person providing the labor, or it could be a robot. In either case, it's actually labor that's used to accomplish an action. And we can capture the costs associated with that. Now, the manufacturing overhead starts to get complex because we have various types of activities, and they're not specifically identified to one item or one type of product. And as the slide says, manufacturing costs cannot be traced directly to specific units produced. The most common examples are referred to as the indirect materials and the indirect labor involved. So, for example, in Toyota's factory, it gets dirty, so it has to get cleaned. The floor has to get cleaned. The air has to remain clean. And there are cleaning supplies used in an assembly plant. So those cleaning supplies to clean the floors, to clean the walls, to clean the air filters so the air remains clean throughout the whole factory. All of those materials are referred to as indirect materials, because there may be 1,000 cars created in 1 week in the Toyota factory. They could be different types of cars, large cars, medium-sized, small. But the factory has to remain clean. It gets cleaned every 6 hours. So the costs involved The expenses involved in the cleaning cannot be directly assigned to a type of product. Because one day we may be making small cars, the next on Tuesday maybe it's medium cars. On Wednesday it could be large cars. So we can't easily trace the costs of the cleaning items to those types of cars. So it goes into an indirect material category. Likewise, indirect labor. It's the people who are working at the plant or at the factory, but they're not specifically making the product. They could be cleaning the factory. They could be managing the factory. They could be accountants at the factory. They could be HR people addressing the HR needs of the factory workers. There could be a lawyer there. There could be IT programmers there. These are the people that are not directly involved in production or assembly, but they contribute to the operation of the plant. Those types of people are indirect labor. Okay. Now, every organization has, that's a manufacturer, has manufacturing costs, but it also has non-manufacturing costs. And we have to capture those in specific buckets. We're creating a product for the purpose of selling it. So there will be a sales activity. And whenever there's a sales activity, there will be costs, there will be expenses associated with the sales activity. So that is not a manufacturing cost. It has to be categorized and reported differently. So selling costs are those necessary to secure the order and deliver the product. So it's actually achieving the sales event. The administrative costs are those that are not involved in the selling and they're not involved in the assembly of the product. So they're going to be your senior managers, they're going to be some clerks, they're going to maybe be the receptionist, maybe the guards walking around protecting the environment of the factory. You can imagine there are administrative expenses involved. So those have to be captured and reported separately from the manufacturing costs. Okay, let's go to learning objective number 3. We need to distinguish between product costs and period costs. We need to be able to give an example with each. Now, you'll see it's pretty easy to understand, but it gets very confusing for some people, and some costs behave differently. In the world of accounting, we refer to costs or expenses as having behavior. And what does that mean? The behavior of an account means the way the account acts, the way it performs, the type of activities that we record for an account, and it may behave differently. So product costs behave differently than period costs. So behave and behavior are words used with costs and with managerial accounting. Now, what are some of these product costs? Well, product costs by its very term suggests that the cost can attach to a product. That means it's attaching, it's part of something we make, something we assemble. It is very clear. So it's going to include what? It's going to include direct materials, it's going to include direct labor, it's going to include manufacturing overhead. So that's very specific. When we looked at the Ferrari that we were making, the direct labor, the direct costs, the direct materials, the overhead in our factory that was allocated to the Ferrari, that is very specific to the Ferraris and its product costs. Okay, and it touches both the balance sheet and the income statement. And we'll see a little later how we do the accounting, but those are the two main financial statements in an organization. The balance sheet, which shows your assets, liabilities, owner's equity, and also the P&L statement, profit and loss statement, also called the income statement. When it comes to costs, product costs, it touches both of those financial statements. Now, think of a different type. Period costs. Period costs have a different behavior than product costs. What does that mean? Well, selling costs and administrative costs happen day after day after day. And because of that, we want to record and recognize those costs as expenses. And those expenses hit the income statement or the P&L statement. Now, let's talk about definitions. Cost versus expense. The proper definition of cost is an asset that has not expired. So a cost is something that we still have in our possession. We still have not sold it. We still have not completed the entire business cycle. So that's the cost. If we have Ferraris, if we've built 10 Ferraris and we have not sold them yet, they are costs. If we have done certain activities, but it has not completed or expired, that is still a cost. When something is actually expired and finished, then we call it an expense. Okay, so the electricity that happens every day, we use electricity and we have to pay electric company invoice every month. That is expired. We pay the gas bill every month because we used gas in our operation. That has expired. If we pay salaries to people who have worked during the month, they have finished their work. That salary is an expense. So it is expired, it is finished, it is gone, it's complete. So all selling costs and all administrative costs are recorded truly as expenses. And an expense, by definition, hits the income statement. It is recorded on the profit and loss statement. Expenses are not recorded on the balance sheet. Okay? Well, this will become more clear as we go through this lecture and other lectures. So, let's just check ourselves and see how well we're understanding up to this point. Which of the following costs would be considered a period rather than a product cost in a manufacturing company? Okay, again, is it a period cost or a product cost? A period cost means it's being expensed in the month. It is expired. A product cost is attached to the product. It has not expired yet. We haven't necessarily sold the product yet. Okay? So the manufacturing depreciation, the manufacturing equipment depreciation, this is an expense. It is completed. That would be a product cost. Okay? The property taxes on corporate headquarters, that would be a period expense. It does not attach to a product. Direct materials costs, very simple. It attaches to a product, so it's a product cost. Electric costs to light the production facility. So this is the electricity that's charged by TEPCO or PEPCO or whatever power company is providing the electricity. those to light the assembly plant, that's going to be overhead. Okay? Now, electric costs to light the production facility, I would classify it as indirect overhead. That's assigned to a product. Sales commissions, we saw in the previous slide, sales activities are period cost. Okay? Period. It's the income statement. It's recorded. It does not attach to the product. It attaches to the period. So let's see how we did. Property taxes on corporate headquarters and sales commissions are the only two period expenses. Okay? Manufacturing equipment depreciation, direct material costs, and electric costs to light the production facility. These attach to the products being made. Easy to understand. Okay. Now, two other terms we need to become comfortable with are prime cost, conversion cost. We're still in the manufacturing world or the assembly world, but not so much assembly. This is actually companies who buy raw materials, direct materials, and then convert them with labor or with robotics or some conversion technology to make a finished good. So the prime cost, that term called prime cost, is one where direct material and direct labor are identified. Those two are called prime costs. So the prime cost of our Ferrari that we're building is the direct material and the direct labor. That's the prime cost. Now, the conversion cost is taking some of that direct labor, but it's also adding the manufacturing overhead. What's that again? It's the electricity to run the plant. It's the cleaning items to clean the floors and clean the air filters, right? It's the wages and the salaries of the support staff in an assembly plant, wages and salaries of the accountants at the factory, or the production manager at the factory. Okay, so those tend to be classified as manufacturing overhead. Conversion, the English word conversion, means to make something from something else, to transform an item. So here we are transforming raw materials into finished goods. That's called a conversion cost. We are converting it, making it into something different. Two buckets, two terms used quite frequently in managerial accounting. Prime cost, conversion cost. Okay, we kind of touched on the next idea earlier. There are two worlds, two paradigms we need to clarify. We have merchandisers, we have manufacturers. What is the difference? Merchandisers simply buy finished goods and they sell them. And they sell them at a price higher than they buy them at. Simple business. And that difference tends to be a margin. And hopefully the margin from the sale of their products is enough to cover their variable expenses and their fixed expenses, and they can turn a profit. So merchandisers don't make products. They do not assemble products. They do not have direct labor, or in the sense of making products. They could have employees, but they don't use direct labor, direct materials, indirect overhead. Those kind of accounts and cost behaviors are not with merchandisers. Manufacturers or assemblers have direct labor, direct materials, overhead, indirect overhead, manufacturing overhead. And manufacturers actually buy the raw materials and they produce and sell the finished goods. So they do the conversion, they have prime costs, conversion costs, like we just saw. The Toyota, Honda, Nissan, Daikin tend to be manufacturers. Merchandisers tend to be the department stores or the food stores who get the products and then they just turn and sell them. Okay? Now the balance sheet of merchandisers and manufacturers tends to be different because of the very nature of what they're doing. Again, a merchandiser is not buying raw materials. It will not have the conversion process. So a merchandiser is not converting cocoa beans into coffee. Okay, so if we are merchandising coffee or Nestle's Excella or Nestle's Gold Blend at 7-Eleven, 7-Eleven is a merchandiser. Okay? Nestle is the manufacturer. Nestle buys the cocoa beans and they then convert the beans into coffee, or they convert tea leaves into tea. That's work in process. The finished goods are Gold Blend coffee, Excella coffee, or a tea product or a chocolate product. Now, that's what the manufacturers do. So the balance sheet, which includes assets, liabilities, owner's equity. On the left side, the balance sheets of the balance sheet, you have current assets. So the current assets of a merchandiser are different than the current assets of a manufacturer. Different paradigms they're operating in. Okay? So a merchandiser is buying products, putting it in inventory, selling the inventory. Okay? Manufacturers have a different type of inventory. It has the very raw materials, the work in process, and the finished goods. So finished goods for a manufacturer is comparable to the merchandise inventory for a merchandiser. So have to be careful, but when you see the balance sheet of a merchandiser versus a manufacturer, you will quickly see which paradigm they are operating in. Okay? Yeah. The materials waiting to be processed are called raw materials, and then work in process, WIP, is when a product is not yet finished. It's in the process of being created and completed. Okay, and then lastly, finished goods are the very final products that have completed the conversion process, done the Q&A, quality assurance, and they're ready to be put into inventory for sales. Fourth learning objective. Now that we've got the basics down, we are going to walk through how an income statement or profit and loss statement involves the cost of goods sold. Now, this is a trick question. We just talked about costs. And costs are unexpired assets. Assets, A-S-S-E-T-S. So a cost is something that we have not actually sold. We haven't transferred to another person, another customer. However, there's one confusing term used in accounting, and the term is not correctly used. Cost of goods sold. If the goods have been sold, they've actually completed the business cycle. It's finished. It's been sold. Customers paid, hopefully, or will be paying the money. So this actually expired. So if we wanted to be really precise in our use of the English language and accounting terminology, we should say expense of goods sold. However, this is the famous mistake that the accounting experts made 100 years ago. Came up with the term cost of goods sold. It was a misnomer, but that's the trick question. Okay, the income statement. This is the one near and dear to everyone's heart. People make wonderful bonuses, make wonderful personal profits, or they get fired as a result of the income statement or the profit and loss statement. This is what drives share prices. This is what also drives fraud and accounting games and creativity, because the income statement or the P&L statement is what the whole world looks at when it evaluates a company's performance. So let's look at the income statement in the sense of just part of the way. So we've got the merchandising company, which we've talked about, a manufacturing type of company, two different types, two different paradigms. The cost of goods sold is going to be a different type of account if you are simply buying and selling goods. If you're a merchandiser, right? You're buying inventory, then you're selling inventory. So the way we calculate COGS, cost of goods sold, is a little different than it would be if we were a maker of the goods that we're selling. So a manufacturing company is a maker, and so we have to report a little differently and do a little different calculation. So when it comes to a merchandiser, we are not making the product, we are buying and selling products. So we would say, we use the term purchases. And on the left you can see that, it's purchases. Now, if we're actually making products, the only thing we're purchasing is what? The raw materials and the labor necessary to make the product converted. So on a manufacturing company's P&L or income statement, we will see cost of goods manufactured as a line. That's a little different than just purchases. So there's your distinction between the two types of companies. Now, for inventory accounts, here's the universal equation. It's frequently used in accounting problems, in examples, in every textbook. You're going to find this. So the basic equation is start with the beginning balance. Look at the additions you've made to the balance. You come up with an ending balance, and then you have withdrawals from the inventory. Okay? This will become clear as we work a few examples. Start with beginning balance. Look for the additions made to the beginning balance. Look at the ending balance and the withdrawals from it. So, take a simple example here. If our inventory balance at the beginning of the month was $1,000, and we bought $100 during the month, and we sold $300 during the month, what would be the balance at the end of the month? Well, this is such a simple problem. Most of you can do it in your head. You don't even need to write it down on paper. But you would logically do what? Well, your beginning the balance is $1,000. You bought 100. So how much did you have available to sell during the month? $1,100 worth of product. You actually sold 300. So from the 1,100, you would take away 300. What would be your ending inventory balance? 1,100 plus 100 minus 300 gives you $800 worth of ending inventory product. Correct? Easy to understand with this simple example. I wish every accounting situation was as simple as this, but that wish is just a wish, because you will find great complexity in this simple process. Imagine a company with 1,000 products. So, and imagine the company's buying inventory products every day. So throughout the course of the month, you have 30 purchases. What if it's more than once a day, twice a day, 3 times a day? You may have hundreds and hundreds of purchases during the month. And if you have a dynamic sales function, it could be drawing down on the inventory constantly. So it doesn't take much imagination to see how very quickly this can be a complicated situation. Okay, next we have to build a schedule that's called a cost of goods manufactured. Now this tells you right away from the very term cost of goods manufactured. What type of company is going to use this? Is a merchandising company going to have this schedule? Or is a manufacturing company going to have this schedule? A manufacturing company. A company that merchandises, which means it buys and sells, doesn't have a cost of goods manufactured. So, what does this mean? The cost of goods manufactured schedule is one of the first schedules we have to make in calculating our financial position. Okay? Accountants use the word schedule very frequently. A schedule shows various numbers. It shows costs, it shows expenses, it shows numbers in an attempt to explain a business situation. So schedule doesn't mean your diary, doesn't mean the time of day, doesn't mean appointments. It means this is a file or a piece of paper that shows, or a calculation sheet or an Excel spreadsheet that shows all the various costs, perhaps, and sales involved. Okay, so this specific cost of goods manufactured is going to show the cost of raw material, the cost of direct labor, and the manufacturing overhead used in the production. Okay, so where do we get these? We talked about them a few slides ago. These are the components of a product. They are the raw material, the direct material. Also, you could say direct material or raw material. The direct labor, that could be human labor, it could be robotic effort as well. And then the manufacturing overhead. So that's going to be displayed on the cost of goods manufactured schedule. Now, we calculate the costs with the goods that are made during the period. Here's the special term, period. Period cost. Okay, we want to capture it in its appropriate buckets in a specific period. And what is the most common period? Usually a month, 30 days, 31 days, right? A calendar month is usually the period we use to capture and report. It's just a matter of convenience. Okay, so let's see how this flows. We start with raw materials. So manufacturers buying raw materials. Nestle's buying cocoa beans from all over the world. I used to work at Nestle. We used to do this all the time. We buy raw materials from all over the world. So we have a beginning raw materials inventory. So on January 1st of the year, we know what our raw materials inventory is. And throughout January, we buy raw materials. So in the case of Nestle, we're buying lots and lots of coffee beans. So at the end of January, for Nestle, it's going to show what we had on January 1st. It's going to show all the coffee beans that we purchased during the 31 days of January, and that will come up with all the coffee beans, the price of the cost of all those beans, which are the raw materials available for use in production during the month of January. And on January 31st, we will take account and say, here is the ending raw materials inventory. So if we started with 1,000 bags of Blue Mountain coffee beans on January 1st, and we purchased another 2,000 bags, Then we had 1,000 plus 2,000. We had 3,000 bags of coffee, which were raw materials available for use in production, okay, during the month of January. We had 1,000 to start with. We bought 2,000, so 1 plus 2 is 3,000. At the end of the month, on January 31, let's say we had 500 bags left, 500 bags of coffee. So what was the raw materials used in the production? Well, 1,000 to begin with. We added 2,000 in purchases, and the ending inventory was 500. So 1,000 plus 2,000 minus 500 is 2,500. That's how we build the schedule. And when you have the raw materials used in production number, we can then move to the right and determine what were the costs involved in making the finished goods. Okay, so what are the manufacturing costs? Well, part of the manufacturing costs are the actual direct materials we used during the period. So, as items are moved from raw materials and put into the production process to be converted, they are called direct materials. To be specific with these terms. Okay? Now, you've got raw materials, which are coffee beans. You add direct labor. People in the factories are involved in the production. And if we've got a factory or an assembly place, an assembly plant, we have manufacturing overhead to assign. So we have all of these components are costs involved in the building of our manufacturing costs, and this will attach to the product. We call these conversion costs. Okay? These are the costs you incurred to convert direct materials into a finished product. Okay? Next, we've just found a number called total manufacturing costs, and we can use that to now determine our work in process. So as you see, there is a step-by-step method, and we follow this in many industries. So we can spend an entire 10 weeks, 12 weeks, 14 weeks talking about nothing but costs. So there are people who spend their entire career as cost specialists. It's called a cost accountant. They become cost experts. And you can see if you have a complicated arrangement like General Motors or Ford or Nissan or Toyota, costs can be very complicated because you have so many components and you have so many products. It becomes very, very challenging. Okay, work in process. Here we go. We got beginning, work in process. So just like the format we've always used, start with something that begins, beginning, work in process. We add the total manufacturing costs, which we just calculated in the previous column. And then what do we come up with? Total work in process for the period. There you go. Okay, moving on. Now, we have to take away the ending inventory, and that will give us costs of goods manufactured. And that's a key number we need to know. So that's our process, that's our step-by-step approach. So once we've got our costs of goods manufactured, we can go back to our few slides ago, we were looking at the difference between the merchandising company and the manufacturing company, and it came down to this. Manufacturing companies show cost of goods manufactured. A merchandiser doesn't have this. Only a manufacturer does. So, beginning finished inventory goods, cost of goods manufactured comes in. What's the cost of goods available for sale during the period? You take away your ending finished goods, you end up with the cost of goods sold during that period. This is a structured approach used over and over again throughout all industries. It's very standard. Okay. So here is a graphic showing the manufacturing cost flows. All right? So on the left, we've got the different types of costs. We've got the material purchases, direct purchases or direct materials. We have the direct labor. Again, it's either humans or the robots. And then we have the manufacturing overhead, which is the indirect labor and the indirect expenses. This flows onto the balance sheet in a few ways. It has to show the raw materials have to appear in our inventories account on our balance sheet, and the direct labor and manufacturing overhead come through in our work in process. Okay? We don't have labor as a bucket in raw materials, and you don't have manufacturing overhead as a bucket in raw materials. These are buckets used in work in process because they're actually converting raw materials. And then you have the finished goods, the final completed product. And that's how it touches the balance sheet. When the finished goods component, when it actually gets sold, when the salesmen do their job, they actually complete a sale. The products are shipped from an inventory warehouse in our income statement or P&L statement. The cost of goods is derived and reported. Now, the top portion of the slide, you can see how costs attach to products. On the bottom side, you have period costs. These are reported in the period. So selling and administrative, all sales activities must be reported in the month. So all the expenses involved in sales, the travel, the entertainment, the gifts, the salaries of the salespeople, all of that is selling expense, and it's reported every month. And administrative, the factory, the managers, the back office staff, the accountants, the HR people, the lawyers, the operational people, all of those expenses get booked, get recorded, get recognized in the period in which they occurred. Okay, they do not attach to the product. Sales expenses do not attach to the product. Administrative expenses do not attach to the product. This is a key point. Therefore, it is recognized in the month that it occurs. Okay? Here is where people play games, they play fraud, and this is how companies end up bankrupt, how many fraud cases, which we'll explore during this course, the Enrons, the WorldComs, the Health Souths, they attempt to move selling and administrative from the P&L statement, from the income statement. How do they do it? They make them period costs. Because if you make expenses attached to a product, it will not hit your income statement until you sell the product. Okay? And this is a way to show more profit per period. We'll get into that a little later. So let's do a quick check. Here's our beginning raw materials inventory, $32,000. During the month, there was $276,000 of raw material purchased. Okay, so we've gotten two key items. $32,000 of raw material to start with. You add $276,000 in purchases. What do those two add up to? $308,000 of raw materials available to use in the period. At the end of the month, $28,000 was still left over, so that's the ending inventory. What was available for sale? 32 plus 276, 308, right? That was available for sale, available to use during the month, 308,000. At the end of the month, you had 28,000, so 308,000 minus 28,000 is, I think it's going to be 280,000. 280,000. Look at this slide. It shows this is the correct answer, but it circles the wrong one. And that's just to keep you awake. Are you still awake at this point? We will see. Hopefully. Okay, another quick check. Direct materials used in production, total 280,000. Direct labor was 375,000. Factory overhead was 180,000. What were the total manufacturing costs incurred for the month? First bucket, direct materials, 280. Direct labor, 375. Factory overhead, 180. What were the total manufacturing costs? Well, I would say 280 plus 375 plus 180. So what is that? Well, 280 plus 180 is 380, 460. 460 plus 375 is what? 775, 835, 835,000. Let's see if it's correct. There you go. We got it. 835,000. Now let's keep moving. Let's go on. I think we got it. All right. What happened to you? Learning objective number 6. We are halfway through this lecture. I just want to make sure we are recording everything well. Everything looks fine. Okay. Let's keep rolling. Learning objective number 6 is understand the differences between variable costs and fixed costs. And predicting cost behavior. How costs will react to changes in the level of activity within a relevant range. Here is a very important concept. Variable costs versus fixed costs and relevant range. We have 3 key items here. Start with variable costs. Well, let's see what the next slide. The variable cost changes as the activity changes. And the most common example used is your cell phone. Now, cell phone plans get very complicated, but let's say that for every text you sent or every time you spoke, you had to pay an expense. So, the cost per talking or the cost per text remains constant, it remains fixed, but the number of minutes we talk or the number of texts we send varies, and so that drives the variable cost. Okay? So in the case of a cell phone again, we may have a monthly fixed cost. So even if we use 0 minutes or 0 texts, we may have to pay $50 to have a cell phone. That doesn't change. It is fixed every month. It does not vary. That is a fixed cost. Okay? So, fixed costs will vary not by the nature of its cost, but it will get less as more activity occurs. So let's spend a few minutes on this chart because it tends to be very confusing for people. 2 broad categories of costs. It's either variable or it's fixed. Variable or fixed. And when it comes to total costs, this is the second column now. I'm talking about total costs. The total variable cost changes as the activity change. So for every minute we speak or every text we spend, if our cell phone plan charges us 1 penny or 1 yen or 1 euro per minute or per text, the number of minutes or the number of texts in total will represent the total variable cost. So if we have 10 minutes and each minute costs $1, it would cost us $10. Okay? Now, total fixed cost doesn't change when the activity level changes. The total fixed cost does not change. In our cell phone plan example, if it costs us $50 a month to have a phone, no matter what we use with that phone, even if we don't even turn it on, we have to pay $50 or 5,000 yen or 50 pounds. That is a fixed cost. That total does not change. But moving on, third column, per unit. The variable cost per unit does not change. So for every minute we speak, for every text we send, if it costs us $1 or 100 yen, the per unit does not change when it's a variable. But the fixed cost per unit goes up or down as the volume changes. Right? Per unit. The per unit fixed cost varies. Okay? It changes. It will become clear as we go over this several times. So which of the following costs do you believe, or they're asking, which one is going to be variable? Which of the following costs would be a variable cost with respect to the number of ice cream cones sold at Baskin-Robbins, 31 flavors? There's probably more than one answer. Okay, so here we are. We're selling ice cream cones. Baskin-Robbins shop. Okay. What is variable? Is the cost of electric lighting the store, does that vary? No. Does the cost of the wages of the store manager at Baskin-Robbins ice cream shop, does that vary? No. Does the cost of the ice cream vary? Yes. Because if we sell 50 ice cream cones or 5,000 ice cream cones or 50,000 ice cream cones, the quantity of ice cream varies. Therefore, that will be a variable cost. How about the cost of napkins for customers? Well, if there are 5 customers versus 500 customers, the cost of the napkins would vary. So I would say C and D are variables. There you go. Now, what's the difference between direct costs and indirect costs? This is learning objective number 7. What's the difference between these two major types? Another set of explanations. Direct costs are those that can be easily traced to a product. Okay? Costs that can be easily or conveniently traced to a unit of product or other cost object. So it's got to have a direct trace. Direct labor, direct materials are examples. Okay? Indirect, by its very word, it's hard to find the trace. It's hard to find the path. And that's where it's commonly referred to as manufacturing overhead, or just overhead. Right? The cost of cleaning the operation, the cost of cleaning the floor and the cleaning the glass, it's an indirect expense. Okay? Costs of the back office people, indirect expense, indirect overhead. Learning objective number 8. What are the cost classifications used in making decisions? Differential costs, opportunity costs, sunk costs. Key terms: differential costs, opportunity costs, sunk costs. A lot of mistakes are made here, so let's try to understand them. Okay, every single day we have a choice between two options, two alternatives. And those costs and benefits that differ between the alternatives are the ones that are relevant. Only the ones that change, only the cost differentials. Differential analysis, what changes between two options? What changes between two alternatives? All other costs, all other benefits should be ignored. And this is where it causes many mistakes, much confusion. You need to look at only those components that are changing. Okay? Differential analysis. It's also used in the medical field. Now we're using it in the financial analysis field. Okay? Let's see. Get more clarity here. Costs and revenues that differ among alternatives. So let's say we have a job paying $1,500 per month in our current town, our hometown. And then suddenly we have a job offer in another location, different place, different city, and the pay is different. So currently we're making $1,500 a month. We have an opportunity to go somewhere and make $2,000 a month. But we're not moving homes, we're actually either riding the train or riding the bus or driving a car that extra distance. And that extra cost to go from our current place to the new city is $300 a month. So all we have to look at are those elements that have changed. And what is that? Well, there's been a change in the revenue, or in our case, the pay. We're currently getting $1,500. We will get $2,000. So what's the difference? $500. Instead of saying what's the difference, we say differential revenue or differential pay. It's the net difference. In this case, it's $2,000 minus $1,500, so the net difference is $500. All right, that's the differential. Now, what is the difference in the costs involved? We looked at the revenue, now we got to look at the differential in the costs. In this case, the only difference is we have to spend another $300 in getting from here to there, either by bus, by train, by car, okay? So the pure differential cost is $300. So our differential revenue, $500. Differential cost is $300. Another way to look at it, our differential pay, if this is a job, we can get $500 extra pay, but it's going to cost us $300 in riding the train to and from to get there. So what's the net going to be? The net, go back, is going to be 500 minus 300, 200, correct? That's going to be the differential between the costs and the revenue. Now, go back, here we go, here's a new concept, opportunity cost. This is frequently used as a term, but frequently mistakenly used. What does opportunity cost mean? It's the potential benefit that is given away, given up, when one alternative is selected over another. So what does this mean? Let's say right now you are not attending a university and you could be earning $15,000 per year in a job. Okay, you're young, you're 18 years old, you could be working somewhere and making money. So you have to face the question, if I go to university and study full-time, I may not have a job. So that means what? It means you are no longer going to receive money. Instead, you are going to be studying and getting smarter and taking courses and becoming certified. Okay? But there is a cost involved. That cost is not only what you pay to university, it's the cost that's foregone. It's that opportunity cost because you're not receiving $15,000 from a job. This is frequently forgotten, frequently excluded from analysis, or it's wrongly explained. So in this case, in our example, right, if you want to stop working and go full-time to a university, there will be an opportunity cost. and that is whatever you forego as your earnings. So in this case, in this example, the opportunity cost is $15,000 to attend school. It's not the foregone salary plus the out-of-pocket expenses for the university. No, that's where many people make the mistake. The opportunity cost is strictly what benefit has been given up in order to take another decision. Sunk costs. This is probably the most misunderstood term, and because of it, many wrong decisions or bad decisions have been made. So, sunk costs. Let's say what's the definition? Sunk costs that have already been incurred and cannot be changed now or in the future. These costs should be ignored when making decisions. It's so true, but so difficult to do. Because people say, well, we've invested this much money so far. Doesn't matter, it's sunk. Okay? All right, so here's a classic example. We buy a car or an automobile for $10,000. That was bought 2 years ago. Okay? The $10,000 that was used is sunk. It's over. We spent it, it's gone. And whether we drive it, park it, never move it, trade it, or sell it, that $10,000 sunk cost is gone. It's finished. It's behind us. Nothing we can do about it. Okay? Now, here's a fun example. Stay with it. Now we are trying to decide whether we're going to take a train or drive. Okay? Let's walk through. I'll read it aloud. Suppose you're trying to decide whether to drive or take the train to KL to go to a Rolling Stones concert. You've got plenty of cash to do either one, but you don't want to waste your money. Is the cost of the train ticket relevant in this decision? In other words, should the cost of the train ticket affect the decision of whether you drive or take the train to Kuala Lumpur? Is it yes, the train ticket's cost is relevant, or is it no, train ticket's cost is not relevant? Which one is it? Relevant costs, one deal. And relevant cost is that cost element that is only changed. What do you think? Yes, it is relevant. Of course it's relevant. That's easy to understand. But now let's make it a little more difficult. So we're still trying to decide whether we're going to drive or take the train to KL to see the Rolling Stones. We've got plenty of cash to do either one. Now let's ask the question. Is the cost of licensing your car relevant in this decision? The cost of getting a license for your car. Now, you can look at this at a simple level or you can look at it as a difficult level. And you're probably clever, so you're going to say the difficult approach. But let's be a simple approach first before we dive into make it a complex example. And this is the problem sometimes we have with the CMA exam, the CPA exam. We look too deeply into the question. So here we're just trying to say, is the cost of licensing relevant? Well, let's say we are now in January of the calendar year, and every 3 years we have to buy a license for the car, and we bought the license a year ago. It's just an example. You already paid the money for the license a year ago. So the car is properly licensed and still has 2 years remaining. In this case, is the cost of licensing the car relevant? The answer would be no, because we already paid for the license a year ago. It's sunk. Now, the clever people there listening in this class are going to say, but that's if it's already been paid. That's if it's already a sunk cost. What if your license expired yesterday, or it's going to expire tomorrow? Therefore, in order for you to drive it to KL, you actually have to go buy a new license and put it on your car. In that case, in this complicated twist, it would be relevant, wouldn't it? Because you couldn't take your car unless you paid for the license. So, there you go. You can look at it simply or with a little more difficulty. So now, let's say, suppose your car could now be sold for $5,000. Right? Remember, you bought it 3 years ago for $10,000. Now you could sell it on the open market for $5,000. Is this a sunk cost? The $5,000 that you could sell it for? No, it's not a sunk cost. It's the fair market value of the vehicle. Okay, moving on. There are two types of cost. There are four types of cost classifications, okay? And here they are. Financial reporting, and that tends to be the classic GAAP reporting. We do predictive cost behavior. We make business decisions, and we assign costs to cost objects. So that's the types of cost classifications we tend to find in managerial accounting. Now, this reaches the end of our lecture. We will follow up with a detailed analysis of labor costs in a follow-up lecture. So this represents the end of this lecture.